This video is about Roth IRA limits and rules. This is the second of two IRA contribution limits and deduction videos that I'm making. The other video is about traditional IRA limits and rules, and you can find that on my channel. I'm Larry Russell. I hold a BS from MIT, MA from Brandeis University, and MBA from Stanford. I'm president and managing director of Lawrence Russell & Company, and this is my LinkedIn profile if you want to take a look. I'm also the developer of Veriplan. Veriplan is inexpensive, do-it-yourself home financial planning software. Veriplan embeds all traditional IRA and Roth IRA contribution limits and deduction rules. Veriplan automates lifetime family financial projections that include both IRA and employer retirement plan contributions, withdrawals, and taxation. This is the Tax Advantage Plans input worksheet for Veriplan. Below in section number 8, we'll find the IRA limits and rules. I'll scroll down for that and just tell you what you're seeing. The top section is where a person and a spouse can enter the type of employer retirement plan that they might have. And you should note, by the way, that some people are confused regarding whether or not they can contribute to both an IRA as well as contribute to an employer plan. In any given year, you can do both. There's a variety of ways to enter different kind of employer plans here. We won't go into those details. There's also a contribution limitation tool for your projections. There's also a couple of ways to manage the analysis of whether Roth contributions will work for you, or there's a detailed year-by-year Roth conversions tool that allows you to figure out what the best years would be to make Roth conversions. As we go down here, this is now section number 8, and this over to the side is all the individual rules related to IRAs. I stopped the video so that I could fiddle around with zooming within Microsoft Excel, and now I'm restarting so that we can see this a little bit more clearly. I'm also setting this up within Microsoft Excel so that these first 4 columns here are going to stay in place while I can scroll over the other ones here, for example, like this. The reason for doing that is because what it depends upon, well, the rules depend upon whether or not you are covered by a plan at work, and that can vary, and we'll see that over here. Now, it doesn't matter if you're single. Obviously, you don't have a spouse, but down here, the reason why there's 4 separate lines is because you might be covered by a plan at work, and your spouse may or may not be. So that's why there's 4 lines, and depending on which line you're on, for example, if you're married, filing a joint return, and you want to do a traditional IRA contribution and deduction, and you're covered by a plan at work, and your spouse is not, the rules may be different than this. This is all due to decades of compromise and fighting within Congress about what the rules to incentivize saving for retirement should be in the United States. So the key thing to realize is you have to figure out which of these lines apply to yourself. For example, related to traditional IRA contributions and deduction limits, if you are married filing jointly and you are not covered by a plan at work and your spouse is, you refer to this line here, and then which would be the second line here, when I scroll back and forth, you'll be able to see that the rules may vary from one to the other related to that, what the deduction limits are. So we'll go over this in a little bit more detail, but that's unfortunately what we have to deal with. And just like with traditional IRAs, Roth IRAs have the same splitting into multiple lines depending on whether or not you are covered by a plan at work and your spouse is covered by a plan at work. For single people, obviously, they don't have a spouse, so there's only 2 lines, and those are you covered by a plan at work or are you not? Down here is where you get into the 4 different lines depending, and that is, Are you covered by a plan at work? And is your spouse covered by a plan at work? Now, I'm going to scroll this back here. The annual contribution limits are the same across all types of IRAs, as well as the over age 50 contribution, additional contribution of 1,000. Is there a maximum age to make contributions? No, there's not. Must your family compensation be equal to or greater than your individual contribution, the combined contributions? And the answer is yes. You have to have at least enough earned income. Does a joint compensation test apply for married taxpayers? Again, that is yes. So if both are over age 50 and both want to make a $7,000 contribution, the family earned income has to be at least $14,000. Now, here's where we're beginning to see the major differentiation between traditional IRAs and Roth IRAs. There are limits, income limits, and it's not so much your total compensation limit, it's your adjusted gross income limit that determines whether or not you can actually make a contribution into a Roth IRA. And so total compensation would just be earned income here, but this would the adjusted gross income would include your deductions, etc., whether standard deductions or whether or not you have higher itemized deductions. But for example, for single people here, if your adjusted gross income exceeds 125,000, then between 125,000 and 140,000, this is where your ability to actually make the contribution to a Roth IRA begins to phase out. And if your adjusted gross income is above 140,000, you simply cannot make a contribution to a Roth IRA. Now, obviously, you can still make a contribution to a traditional IRA, and in a minute, we'll get into some of the tactics you can use. Now, related to married people, the phase out begins at $198,000 and is completely phased out at $208,000. So if your adjusted gross income as married people is above $208,000, you cannot make contributions into a Roth IRA. These remaining columns over here concern whether or not a contribution is deductible, and Roth contributions are never deductible, so none of this really applies. Also, this notes there that there are no distributions that are required in retirement, so you don't have to take distributions, and the primary reason for that is that there are no taxes subsequently on any Roth assets. Now, I've lined up these columns so that we can talk about backdoor Roth opportunities. A backdoor Roth conversion opportunity occurs when you have made previous contributions to a traditional IRA account, but they weren't deductible. So you actually have a tax basis in those assets. And here, let's just focus on single people and see where that situation might occur. First off, if a single person makes a traditional IRA contribution and they're not covered by a plan at work, there's no limitation on their deductions. So they're always going to be able to deduct that contribution. So a backdoor Roth wouldn't apply for this person. But let's assume that this single person did have a plan at work, whether or not they participated in it. In this case, if they made a contribution to a traditional IRA, but their adjusted gross income exceeded $76,000, this means that above $76,000, this single person could not take a tax deduction. Therefore, that means that they would have a tax basis in the contribution they made to the traditional account. And when you're doing taxes, it's Form 8606 that's used to track over time the tax basis in your various traditional IRA accounts. Now, one thing to note about the tracking of tax basis on Form 8606 by individuals is that in most cases, people don't build up a tax basis in their traditional IRAs simply because in most cases they're able to take deductions. But if they're able to build up a tax basis and not have a lot of other IRAs that don't have a tax basis, then there are opportunities to do Roth conversions. And so I'll get to that in a minute. But first, let's take a look at this. Let's assume that somebody had income over $76,000. Well, you could say, well, okay, if they're not going to get a tax deduction, why don't they avoid all the complications and simply make a Roth contribution? Even though that's not tax deductible, they could still do that. Now that's true, except what happens if you have an individual, a single person who's a high earner who happens to make have adjusted gross income above $140,000. In that circumstance, they're prohibited from making a Roth contribution. So a high earner who's self-employed can set up an individual 401k plan and contribute to that 401k plan out of their relatively high earnings. Let's assume that they made somewhere in the neighborhood of $180,000. They could contribute substantially to that 401k plan. And then they could also, even though they were prohibited from making a Roth contribution, they could make a contribution to a traditional IRA, but since their income was too high, they would end up having their contribution to a traditional IRA would be non-deductible. So if they made sure that they didn't have a lot of other IRAs that didn't have a tax basis, and then over time they could do a series of Roth conversions where whenever they did the Roth conversion, there wouldn't be much recognizable taxable income simply because they had almost 100% tax basis in the assets that were held in their traditional account. Regarding backdoor Roth strategies for married people, the situation is quite similar to that of single people, so I won't go into the actual numbers. You can use what I just said related to single people and understand picking the correct line and things like that. But what you should note is that even though people are married and the adjusted gross income above $208,000 means that neither person, whether or not they're covered by a plan at work, could make a Roth contribution. In your tax return, the two spouses will file separate Form 8606s, which really means that what's going on, they're essentially being treated as if they're individuals from the standpoint of whether or not they have a tax basis. So what happens is, in trying to determine the tax basis for Roth conversions, all that gets considered is the IRAs that are held in the name of one spouse. You don't end up pooling the tax basis across the traditional IRAs of both spouses. So therefore, if you have a situation where one spouse has very little money in traditional IRA and has found a situation where they can actually make a non-deductible contribution to a traditional IRA, then soon after that, they could do a Roth conversion. And it doesn't matter that perhaps their spouse may have a lot of money held in traditional IRA accounts that doesn't have a very high tax basis. So again, this is quite complicated, and obviously if you need to, you should do extensive reading of IRS documentation to try to figure this thing out. But the opportunity is there for married people to do a series of backdoor Roth conversions for perhaps one spouse, if not both spouses. That concludes this Roth IRA limits and rules video. If you're interested, I also have done a traditional IRA limits and rules video. You can find it on my channel. Thank you very much for listening, and please subscribe if you are interested. Thank you.